Welcome everyone. Today we are going to pull back the curtain on one of the most powerful tools in investing, the price-to-earnings ratio. Now, I know it sounds a little technical, but trust me, it's not just a number. It's the key that can unlock the hidden story behind a stock's price tag.
So let's just dive right in with a simple scenario. Imagine you've got some cash ready to invest, and you're looking at two totally different companies. And the question seems easy enough, right? Which one is the better deal?
Okay, on one hand, you've got Value Corp Coffee. It's a solid, dependable coffee shop, you know the type. Its stock is just $10 a share. On the other hand, you have Growth Tech Rockets. Super exciting, cutting-edge stuff, but priced way higher at $50 a share. Now, at first glance, the coffee shop seems like a total bargain, doesn't it? But is the share price the whole story?
To figure that out, to find the real bargain, we have to look deeper than just that surface-level price. We need a special kind of tool that helps us understand the value we're getting for our money.
And this, my friends, is where our valuation detective comes into play, the price-to-earnings ratio. We just call it the PE ratio for short. Think of it as your magnifying glass for investigating a stock's price to find out what's really going on.
So here's the bottom line. The PE ratio connects the price you pay for a stock to the actual profit, the earnings that the company makes. It's basically asking a super simple question. For every single dollar this company earns, how many dollars are people like you and me willing to pay for it?
And you know what? The calculation is surprisingly simple. First, you grab the stock's current price. Easy. Second, you find its earnings per share, or EPS. That's just the company's total profit divided by all its shares out there. Then you just divide that price by the earnings. That one little calculation, that's what unlocks this whole deeper story.
All right, let's put our detective to work. We're going to head back to our first company, Value Corp Coffee, and see what kind of story its PE ratio is telling us. Okay, first up, Value Corp's stock price. Simple enough, $10 a share. Next, let's look at what they're actually making in profit, their earnings. After all the coffee beans are counted, they earn $2 for every single share. That's their EPS. And now for the magic. We take the $10 price, we divide it by the $2 in earnings, and what do we get? A PE ratio of 5. So a PE of 5. What on earth does that actually mean? It means that for every $1 of profit this coffee shop is making, right now, investors are willing to pay $5. Just remember that number, 5. Okay, now let's flip the script. We're going to apply the exact same logic to our pricier rocket company, Growth Tech. The process is identical, but, spoiler alert, the story's going to be way different. So Growth Tech's stock price? Yeah, it's a lot higher, $50 per share. But here's where it gets really interesting. When we look at their earnings, their profit per share, it's exactly the same as the coffee shop, just $2. So let's do the math again. A $50 price divided by $2 in earnings, and bam, we get a PE ratio of 25. Whoa, that is a lot higher than the coffee shops. And this right here is the million-dollar question, isn't it? For Growth Tech, you're paying $25 to get that same $1 of earnings that only cost you $5 over at the coffee shop. So why would anyone pay 5 times more for the exact same amount of profit today?
Well, this is where the PE ratio stops being just math and starts telling us a story. It's a tale of what you're paying for now versus what you're hoping for later. It's price versus promise.
Let's put it all together side by side. Value Corp's low PE of 5 tells a story of value. You're paying what seems like a fair price for the profits it's making right now. But, a low PE can sometimes mean the market doesn't expect much growth. Then you have Growth Tech. Its high PE of 25 tells a story of growth. Investors are willing to pay that huge premium because they're betting those earnings are going to skyrocket in the future. But that big price tag comes with big risk. If that growth never shows up, that stock could be seen as way overvalued. There's a great saying that really just sums this all up perfectly. A low PE is buying the present, a high PE is buying the future. With Value Corp, you're buying a stable reality. With Growth Tech, you're buying into a vision, a promise of what that company might become. So the big takeaway here is this. The PE ratio isn't just a simple good or bad number. It's a narrative. It shows you the story that investors believe about a company. And the real question it forces you to ask yourself is, what kind of story are you investing in? Today's solid value or tomorrow's explosive growth? And that is the true power of the PE ratio.